Hello, left fielders. At LFI, you know our focus is on networking and education. Mark your calendars because we're going to have a full day of it dedicated to you, our limited partners, at the Best Ever Conference on April 9th in Salt Lake City. LFI is opening the BEC with Passive Investing with Left Field Investors, an event focused on passive investors. This will be where insightful content meets passionate limited partners. If you enjoyed BEC last year and the meetup in Left Field this year, then imagine them both back to back. The Best Ever Conference isn't just any event. It's the premier conference for commercial real estate investors and operators. Your ticket to Passive Investing with Left Field Investors includes admission to the entire Best Ever Conference from April 9th through the 12th. Join us April 9th, where we will have a packed agenda with sessions focused on how to be a successful limited partner, led by experienced LPs, top operators, and partners. Then, immerse yourself in the full Best Ever Conference, where you will be surrounded by like-minded investors, operators, and industry experts for unparalleled opportunities for learning and networking. The best part, and there are so many, but the best part, you won't find a bigger discount on the regular ticket price than the one you get for being an infielder. That's more content for an exclusive lower price. Register for the event today at leftfieldinvestors.com/BEC, and we will see you at Passive Investing with Left Field Investors at the BEC. Have a deal in mind and a group of investors ready to go? Use Tribevest to pool your capital together through a multi-member LLC. Tribevest has streamlined the group investment process, making it easy, quick, and safe to do business with others. Start a tribe and invite your partners to join. Then you can use the platform to collaborate with your partners, pool capital, and manage your joint investments. I'm in 12 tribes myself. It is a great way to learn from others, spread risk, and get into deals at lower minimums. Go to tribevest.com to get started today.
We don't really have a housing market crash. It's just nobody's really buying and selling right now, right? Everybody's just kind of like, I've got my 30-year fixed rate 3% mortgage. I'm not selling because I don't want to buy another house that, may be less expensive but more expensive on the mortgage and really not give me any benefits. So a lot of stuff just isn't happening.
Hello, left fielders. Welcome to the Passive Investing from Left Field podcast. Our community is focused on networking and education to help people invest passively and think differently. Let's go.
Hi, this is Peter Lenneman, and you're listening to Passive Investing from Left Field.
I'm excited today to have Ryan Gibson with us. He is the co-founder, president, and chief investment officer of Spartan Investment. Spartan Investment Group, They are a left field investor preferred partner, and we are thankful for that. Ryan has organized over $200 million of private equity for Spartan's projects across the country. Outside of Spartan, Ryan is also a highly experienced commercial airline pilot and the host of Passive Income for Pilots, a podcast that talks about exactly what we're talking about today, right? Investing. And he's a previous guest on episode 69 back in June of 2022. So we're excited to get an update what's going on with self-storage. Ryan, welcome to the Passive Investing from Left Field podcast.
Thanks for having me back, Jim. It's been quite entertaining and awesome to watch what you guys have built at LFI. So it's fun to get back on the show with you.
Well, we appreciate it. And of course, we always appreciate the support of Spartan. You guys have been a great supporter of ours, and we're thankful for that. The first question I want to ask is, we already had you on once before, so if people want the full backstory, they can go back to episode 69. But let's get the abridged backstory. And as we said earlier, we'll see if it matches up with what you told us last time. How'd you get here?
Yeah, so I was an airline pilot for actually 17 years and, learned how to fly in high school, got hired by the airlines right out of college. And, I've always been an entrepreneur at heart and quickly found other things to do outside of flying. And one of those things was real estate investing. I started Pilot Crash Pads in, probably about 19 years ago, actually. Time flies. And kind of got into that, but really didn't scratch the entrepreneurial itch as much as I wanted. I moved to Washington, D.C. I bumped into my neighbor who became my business partner. And he bought the house next door to me, Scott Lewis, military veteran, Army guy. And we ended up flipping a bunch of houses and building a bunch of condos in D.C. to get Spartan started. And so I was working in the airlines as a pilot and also working to build Spartan on the side with Scott. And we kind of got fed up with residential stuff, and we said, hey, what's easy to own, easy to evict, and easy to maintain? So we pivoted to self-storage because it was all of those things. That was our decision-making criteria. We also like that it has a 40-year history of good performance. So we jumped into self-storage in 2016 is when we made that decision. And then we just got busy building an awesome company that goes out and buys, builds, and operates self-storage across the country. We've grown that to the 36th largest self-storage operator or self-storage owner in the country. And, we've been growing and developing our team ever since. But that's really kind of my start. Kind of an airline pilot guy. In the airlines, I did a bunch of different things. I was a chief pilot, check airman, sim instructor, did some flight tech pilot stuff. Started the iPad program at a regional airline. Worked as a consultant for the FAA for a while. So really, really involved in aviation. So naturally, I bumped into a pilot, Tate Durier, at a real estate conference, actually the best ever conference. And we kicked off and started a podcast that is called Passive Income Pilots. And it focuses on high earning airline pilots, high income earning airline pilots, and kind of how to strategize their wealth and, different things that we can do. Because unfortunately, I didn't really have any pilot mentors that knew about investing and could see things through the lens of a pilot. And so, I kind of figured it all out on my own with podcast webinars, going to meetups, networking. So Tate and I kind of share our network with all the people we've met and all the experts in the field. There's an old joke with airline pilots, never take investing advice from a pilot. And so, our show is to bring on people that we can then get the information and the experience from. So really, really fun. We have a lot of fun putting that show together. And obviously, it's not just for airline pilots. It could be for any doctor, lawyer, engineer, or otherwise high-paid professional that is looking to build their passive income portfolio. But we do have a slant towards pilots because that's what we do. So hopefully that checks with the last story, but that's my 1 minute story, 2 minute story.
No, that's great. The podcast is new, and I will say it's not only for high earning W-2 earners. I listen to it as well, and it's got a lot of good stuff in it. It's meant for passive investors, and clearly there's some stuff in there that is specific to pilots, and but it's still a good podcast to go for general information. Now you mentioned pilot crash pads. What exactly? Because I don't think we talked about that last time. What is that?
Oh yeah, so yeah, it's kind of becoming less of a thing, but it's been an industry staple for the last 80 or 90 years, basically since the airline pilot profession has been like a thing, where pilots can live wherever they want in the world, and they are responsible for getting themselves to work. So a pilot that lives in Wisconsin that is based in New York, they have to make themselves available, maybe at LaGuardia or Kennedy or whatever. They can commute on their own time and own dime to New York, but then they need to be ready for their flight, say the next day at 6 a.m. So they need a place to crash. And they don't want to get some super expensive hotel. They just need a place to hang their hat for 8 or 9 hours before their next flight. That's not covered by the airlines. So they fly in, and I would set up pilot housing around airports that would provide housing for pilots to do that. And, I was 21 at the time when I did it. I had no money. I was a broke, brand new airline pilot. They get paid really well now, by the way, first couple of years. But back then it was like, you made like 25, 30,000. So what I did was I organized an apartment and basically had, multiple pilots renting for me, and I'd take the arbitrage off the income I would generate from collecting the revenue from the pilots, and then what my expenses would be as an apartment holder. And I would clear it with the landlord and get it in the lease and make sure that, it was all above board. But that's pilot crash pads, and they still exist today, although the airline pilot career has become very lucrative, and I know that some pilot contracts have actually included, pre-trip housing into their package now, where like housing is included or whatever. Now, of course, you're always, the airline always pays for your housing when you're on a trip, but just not before and after. So, but that's even changing. So, I don't know how lucrative crash pads are anymore. I did it during the days of like no PayPal, no Venmo. So, a box on the wall with checks that we'd put in there and have to come collect the checks or get paid cash or something. So, a lot easier to run now. But really, if you do the math, it's not much better than just having a long-term rental or an Airbnb that's hosted by a professional host. But it was fun. Yeah, I did it for a few years.
It's interesting how you find, like, in your job, and this is good advice for anyone, right, who wants now they call them side hustles, but it led to the real estate, right, because you did that, and then you learned a little bit about real estate, and that allowed you to transition to flipping houses, and then now all of a sudden you're the 36th largest self-storage company in the country. I mean, it's interesting that one little thing like crash pads, if you didn't do that, you might not be here where you are right now. So it's just an interesting start, I think.
Yeah, or otherwise a great way to scratch an entrepreneurial itch. And just kind of when you're feeling your way around, you just try different things. And eventually you kind of find what your strengths are, and that's what you go after. And I think that's what we've done with Spartan is, Scott's a strong leader, my business partner. And so he's built a culture at Spartan and attracted top talent. On my side of the house, I've been focused on, building out our investor relations team and raising capital, and also doing some of the business building stuff, obviously, with Scott. But, I'm right in the zone now. I feel like I found my love and my passion with Spartan, and it's really been a lot of fun.
Well, that's fantastic. When you find something you love doing, that's what you want to put your focus on. And speaking of that, can you give us kind of an update on the state of the self-storage market? Last year in June 2022, and we're recording this in late October, Halloween actually, of 2023, you had said the market is overheated. Is that still the case, or can you give us a little bit update of where we're at?
It's amazing that we're getting the value. So we've sold a lot of property in the last 30 days, 30 to 60 days. I think specifically in the last 30 days, we sold like 6 or 7 properties. And it's incredible what people are still paying for them. Cap rates really, if you read all the Green Street data, it's going to tell you, and the information is going to tell you that cap rates have expanded or property values have slightly declined. But we're not seeing that. We're actually seeing a pretty strong appetite for buying these properties, sub 5 caps still. And these are first gen properties that are, in tertiary markets. This isn't like a Class A in a downtown or glass 3-story building. So we're seeing values really strong. Personally experiencing that as of the last 30 days of this recording. So that's good. I think that with disruption becomes self-storage boom, right? So usually self-storage does well when something has been, incredibly disrupted. I mean, so when you think about the disruptions that are happening in today's economy, there really hasn't been a lot of moving activity. There hasn't been a lot of home sales or things that have been trading. So self-storage has been relatively flat in its operational performance this year. But as far as an asset that capital wants to get into, it's been really strong. I wouldn't say, I think overheated is a strong word, but I would say that it's consistently becoming part of a main food group in CRE or commercial real estate. I would say seasonally, we didn't have the best leasing season as an industry because of home sales really slowing. That's what people speculate on. But I think long term, the asset is extremely healthy. And I think supply has been a bit limited in a lot of markets because of the inefficiency to get debt and the kind of inefficient market that we're in. So I think building new property today, if you can get your arms around the financing, the construction, and get it done, I think those types of investments, I think that are being built now are really going to pay dividends in the future, where maybe capital gets a little bit more accessible and things kind of work out. But the other thing that's really interesting right now is a lot of the REITs aren't buying; they're pencils down. So when you think about the transaction volume and the values that we're getting today without the REITs really participating at the moment, it's pretty impressive with what we're seeing in values, because you have a lot of buyers on the sidelines that have the biggest buying power. So as an industry, I think it's good fundamentals. The fundamentals have not gone away. I would say at the heartbeat, it's not necessarily the double-digit rent growth that we had during the pandemic, but it's certainly not down. And if you read the REIT reports, people are like, move-outs are up and pricing is down. But if you actually read the REIT reports, the publicly traded storage companies, NOI is up year over year. So they're still seeing same store growth in their portfolio, but maybe their pricing has come down a little bit off the historic highs of the pandemic boom. So I saw a lot of stuff like self-storage crashed and all that stuff. It's like it didn't crash. It just kind of went back to normalization. But fundamentally, for the long haul, it's doing really well. And
you mentioned disruption is good for the industry, and that's usually what people say is it's recession resistant, right? And so this recession that we may or may not have had or will have or are currently having, where no one really knows where we are right now. I find it interesting that you've said disruption is good rather than, hey, this is an asset class that does well in a recession. Can you talk a little bit about why disruption is one of the things that self-storage thrives on? And I like the categorization of that rather than recession resistant. Disruption makes more sense to me.
Absolutely. You nailed it. And I actually love the way you frame that. I'm actually going to probably re-articulate the way I describe this. But yeah, when you move, you have to use storage. Typically, you don't have to. Usually when I get in front of an audience and I say, I try to demystify why people use storage. Everybody thinks, oh, it's America's overabundance of our stuff. And no doubt we have a lot of stuff. But I always ask the room, how many people here have used storage before, ever? And about every other hand in the room goes up. And I say, okay, keep your hand in the air if you used self-storage because you have too much stuff, and all the hands go down. And I ask people, why did you use self-storage? And they say, because I moved, because I had a home renovation, because I had a death in the family, I have a growing family, I needed extra space in my house because I needed a gym and an office because now I'm a work-from-home parent. Or I was packaging up all my stuff in an RV and hitting the road. Or divorce, or things that created some kind of disruption in their life. And, moving is a disruption. That's a disruptive thing that happens to you, and then that usually triggers a self-storage event. In businesses, you're going to have disruption, and you're going to have moments where businesses need to use self-storage. If you're a Little League baseball team and you need a storage locker to house all your equipment, or if you're a sheet metal contractor, Etsy, Amazon business person, you're going to need a storage unit. 30% of our business is actually business owners. So when you don't have home sales and you don't have a lot of moves going on, you don't really have a lot of disruption in people's lives. And so you're going to see a declining use of storage. I think what's interesting is we don't really have a housing market crash. It's just nobody's really buying and selling right now, right? Everybody's just kind of like, I've got my 30-year fixed rate, 3% mortgage. I'm not selling because I don't want to buy another house that may be less expensive but more expensive on the mortgage and really not give me any benefits. So a lot of stuff just isn't happening. So that means that storage has just been kind of regular. It's just been kind of flat, for the last few months. When that activity picks up, you better believe everybody's going to be buying the stuff they wish they would have bought, 1 or 2 years ago, and that disruption is going to start increasing. And that's why when you saw COVID, you saw tons of disruption. You saw people moving. Work from home was like a boom, right? And so when you have that, when you have, now I can't go to the gym, I need to work out in my house, I have all this stuff, what do I do with it? You had people who were moving into RVs and traveling the country. Lots of different things were happening that disrupted people's lives. So I think that's kind of gone away. And then you also have just a slowing housing market. And those are two main drivers. There's probably a lot of other things that I could talk about for hours, but those are probably the main highlights.
And so you said that the REITs aren't buying, but you've sold several properties recently. So who's buying from you? And then are also aside from that, when they're buying from you, they're buying something that's already been, some renovations done, some value added, right? Because that's what you guys do. So who's buying from you? And then who are you buying from? Are you still buying from the mom and pops? Because I assume that you're still in the market for getting new properties as well.
Yeah, so we've sold to, it's interesting. So I think the portfolio premium strategy is still at play, but you're not seeing the big check writers in the market for portfolios right now as much. So the premium is still a long-term strategy that we have, where you amass a portfolio, you get a premium for being able to write a bigger check. What's interesting is the REITs aren't at play, but larger institutional operators are still really active, and they're actually buying one-off properties more than they have ever before. So, probably 4 of the 7 or so properties we've sold have been to a larger private kind of more institutional operator that has been buying one-off properties. So I would say that's one category. Another category is like another syndicator or a regional operator that is boots on the ground in that market that wants storage in their portfolio, or small family office. And then 1031 exchange buyers are still looking for yield on assets, and self-storage is got that reputation of being a little bit lower operating headache. So we're seeing that. And then we've also seen buyers that are just mom and pop. Quite frankly, we sold one of our assets in the Southeast portfolio just yesterday in Warner Robins. We sold that asset to a mom and pop operator. He has a couple properties in that market already and just really wanted our property because it was already in his wheelhouse. So we're still seeing a lot of activity or thirst for that. And we also have like our fellow competitors that are buying these properties as well.
Hi guys, my name is Vikram Rai. I'm CEO and co-founder of Viking Capital, and we believe that multifamily investing presents a significant opportunity for investors to build sustainable wealth and achieve financial freedom through diversification. We're backed by a team of seasoned real estate experts. We have deep financial analysis and data-driven processes for asset and property management, and this allows Viking Capital to leave no stone unturned in the pursuit of outstanding returns for our investors. Our investment strategy is anchored in identifying low-risk opportunities that offer significant value add potential, enabling us to preserve our investors' capital, all the while maximizing their long-term growth potential. Viking Capital has collectively raised over $250 million and currently has 5,000 doors under management. Learn more about all our current deal offerings at vikingmultifamily.com.
This is Zach Happenstall, CEO and co-founder of Rise 48 Equity. At Rise 48, we've completed over $1.7 billion in total transactions, including 11 successful full-cycle dispositions. If you're looking to invest with an experienced sponsor in either the Phoenix, Arizona, or Dallas, Texas markets, then set up a call with us today at rise48equity.com/invest. That's RISE48equity.com/invest.
Now I want to talk about, because I'm an investor and I'm invested in thankfully one of the deals that just had one of the properties sold, the Tyler Longview portfolio, and for every 50 grand you invested, you're getting 53 back, is my understanding, and you just sold one piece of the portfolio, so we still have all the other properties. So the infinite return model of what everybody kind of likes is what's in play. So can you talk about that and the decision to sell that one, and what happened with that portfolio that made it such a great success?
Yeah, so I won't share pricing of properties on a public podcast just because I don't. Texas is bloodthirsty for valuations of assets, so they can reassess your property. So I'll try to speak around the sales price. But we bought a portfolio. I'll try to keep this short. Four properties in COVID actually that you invested in, and we actually found a fifth property that we included in and figured out a way to manage that, add that property into the portfolio without any additional equity needed. We just kind of financed it creatively. So you ended up with 5 properties when you're only supposed to have 4, and then we got a great offer to unload one of the assets for 4 times what we paid for it, something like that, 3.5 times what we paid for it, which was fantastic because not only that one property sold for almost what we paid for all 5, and so it was an easy decision to get that price to where we had it, and when we sold the property, we were able to not only return all of your capital, but a $3,000 in profit on top of that, and we've been cash flowing, 7 to 10% cash on cash for the last 36 months. So it's been one of those just grand slam, as you put it, investments. And what's neat is we actually exhausted the debt on another property in that portfolio. So of the 4 that remain, we've got a tremendous valuation. I'm happy to share that because it's spread across many properties, but $19 million that that we only have $5 million of debt on. So now you've got all your money back and about $345,000 a year of cash flow on the portfolio, which is still going to provide you with income. So that infinite return is there, and just a great way to, those are the deals that we like. That's a typical. I shouldn't say it's a typical Spartan deal, but that's the kind of stuff that happens at Spartan. I like to say, oh, this will never happen again, but it keeps happening. A lot of our, we haven't sold a lot up until 30 days ago. A lot of our holdings are now starting to turn over for phenomenal returns, which is fantastic. Now, that portfolio will hold, and eventually we'll sell the remaining 4 assets, or return more cash at some point. So really just excited about how that went. So
yeah, I am too. I'm thankful that I'm in that one. And then we also have to talk about challenges, right? And I know there's a Dallas portfolio that has had some, I guess, challenges, right? So can you talk about that too? It's not, you're never going to get into this passive investing deal and have all winners, right? You're going to have some that struggle, and I think it's illustrative of what Spartan does to talk about, hey, here's one that we're struggling on, and here's what we're doing to get to make it better.
Absolutely, and I think it's important to note that things aren't going to always go exactly as planned, but it's how you get back up. It's what you do with it that really matters the most. So we bought a portfolio in September 2021 that we had financing challenges with. And, if you go back in time, you'll read the news that, in the winter of 2021, interest rates were supposed to go up. And if you read most of the reports, the smartest shop said interest rates are going to go up, a point to a point and a half in the new year. And so unfortunately, by the time we had that financed, it was July of 2022. And you're like, wow, why didn't you finance it sooner? Well, we were trying. we had, that was like all we were focused on for a period of time. And interest rates went up, 5.5%, not 1.5 in the worst case scenario. We ended up with a really good loan, but it's a floating rate. And unfortunately, everything we've ever done at Spartan has been fixed interest rate. We never want a floating rate. Any floating rate we get, we turn down. Unfortunately, our backs were against the wall on that one. We ended up with a floating rate, and that investment was at a SOFR plus 205, which in early 2022, you were running worst case scenarios on a SOFR plus 205, and that's actually not a bad loan. But when interest rates go up 5.5%, it makes it a little bit less of a loan. So I don't think we're not experiencing any other challenges that other people are having. The good news, no capital calls. And we're actually selling properties in that portfolio right now at a really great price. So we've got a plan to completely eliminate the debt on that portfolio. So we've got a plan to kind of work through the challenges that we've had. We've staffed up our team really well with a regional manager that actually came from one of the REITs. We recruited a top executive out of Extra Space to man our free up storage portfolio. And we've been putting resources into that portfolio to turn it around. We've actually sold 3 properties already for great prices. And again, our plan is to kind of reduce the debt on the portfolio and refinance into a fixed rate long-term debt on that. So, we're not perfect. I mean, I think when you look at other big institutional shops, you look at the stock market, you look at other operators, they're going to have challenges too. And to think that you're never going to have a challenge and this is always going to be only upside, I think you're in for a surprise. And operators that don't have challenges either haven't been around long enough or, are not telling you the whole truth. I mean, we definitely have had our issues with DFW. But, I think the way the team has pivoted and the strategy that we have to fix it has been really good. So
yeah, and I think that's the key, right? Is you're going to have these deals. You're not going to be a company that's investing in anything without having these struggles. It's what do you do to fix it to make sure that in the end it ends up where you want it to be? And in that a question I have is, it seems like most of these deals you're buying groups of properties, right? It's not one single deal. It's not. I know you're doing a fund now, but these deals weren't part of a fund. They were just part of a package. Can you talk about the advantages and if there are any disadvantages to buying that way, where you're buying 3 or 4 properties at once? It seems like, the advantage is you can, if one of the properties is having troubles, you might be able to get rid of it. Or if one of the properties is going gangbusters, you might be able to get rid of it. Both ways, you can save the rest of your portfolio. Can you talk about why you structured the deals like that?
Yeah, so I think first and foremost, I think one of the lessons learned from that portfolio was what we should have done was in the transaction, we should have broken up the assets that were ground up in value add expansions and the ones that were just cash flow plays. And we should have offered it as 2 syndications, one for those that wanted the ground up more upside potential and ones that were just cash flow. Because there's some really good assets in that portfolio, depending on your investment preference. If you want that down and dirty expansion with no cash flow and absolute upside potential, you could have had that. If you wanted those steady eddies that just cash flowed, you could have had that. I think our lesson learned was we bought that portfolio as a big package and tried to thread the needle of satisfying the upside investors with the cash flow investors. And I think that's where a lot of the frustrations have come. Is it's not that it's a bad investment. It's a bad investment for those who have a profile that want cash flow. And so it's not going as projected, right? But it doesn't mean that the investment is going to lose money or that the investor is going to, have any negative things come out of it when it's all sold and done, right? Because it's a 5-year hold. So I think when you look at taking down a portfolio, I think the advantages is that you can chop it up like that. Another advantage is you can finance it all with one lender. You also get the economies of scale by having a lot of assets clustered within a particular market. Now, that portfolio may comprise several states, but that is pretty consistent with being focused in one market. I think it's a lot of work to buy a bigger portfolio like that because you're doing simultaneous due diligence in the portfolio. And so we've tried rolling closes and we've tried closing it all at once. I think either way you do it, you're going to have your challenges, but there can be some great advantages to picking up some great product all at once. And then likewise, if you do it one syndication at a time, it's a lot of work to do, to buy a small $5 million property at a self-storage facility. So there's advantages and disadvantages, but I think the takeaways there was just how we chopped up the portfolio. I think we would have done it a little bit more strategically next time.
And I want to talk about investor expectations because, we went through a few years there where, not just in self-storage, but all the asset classes, it seemed like, you had a 5-year business plan and it was completed in 18 months or 2 years. And so people got used to having these properties almost flip, right? Like you're just doing a little bit of rehab, then you sell it. Or they're used to the exact same amount of distributions every month after month. And, they don't always, everything doesn't always run so smoothly. So, we're not just talking about this DFW portfolio, but when something struggles after 2 years or interest rates go up faster than anybody ever thought or insurance costs go way up and all of a sudden investors are thinking, well, why isn't, this 5-year plan, you're behind already after 2 years or you're withholding distributions. Can you talk about kind of managing those expectations? Because at Left Field Investors, we try to say, hey, you know what, this is, compared to the stock market, we're much better off. But sometimes withholding distributions is a good thing, or sometimes slowing down the business plan is a good thing. And you just got to look, well, hey, you're still going to be there after 5 years. So I know that was a lot, but can you kind of talk about that subject a little bit?
Yeah, I think, our main goal is to preserve capital. We don't want to lose anybody's money. And so when we think and make decisions, we're doing it in the best interest of the investors. And so, I think being transparent about what you're doing, like we have been, where we communicate on a monthly basis and we say, this is exactly what we're doing. This is what went wrong. This is what we're doing to fix it. And staying connected with the investors, I think, is really important. But I do think if you're doing a syndication or you're investing with anybody or really doing any investing, you've got to know that there's going to be challenges in an investment. And so I think, we've always done a pretty good job, I think, of managing expectations. Unfortunately, we were dealt a bad hand. And we were quick to hold webinars, communicate monthly, share financials, share occupancy data, and even though we acknowledge that things were, we've had challenges, that all that information has been shared. So I think managing expectations going forward is really just all about communicating with the investor to ensure that they understand what's going on and what we're doing to improve it. And so I think that's part of it. As far as disclosing or talking about risks, I think that's why the PPM is so important, because that's where we're going to kind of outline that, hey, this is an illiquid investment. These are just projections. Outside things can influence or impact your distribution or your potential profit. So I think investors should be aware of that, and also just kind of know that when you do these investments, that they're not always going to go perfectly. And I like what you said, because a lot of our investments, we've been landing punches right out of the gates. It's like, we bought an investment and it's like, yeah, we thought rents were going to go up 7% over a 4-year or over a 5-year period, and guess what? They went up 20% in the first month. And it's like, and you have this great news to share, and everybody's just, like you said, everybody was kind of used to that, right? But we've also seen a lot of operations go sideways. We've seen tons of operators do capital calls, lose money, lose the assets, right? And so I think that I would pick an operator that can fight through that stuff like we have, right? And I could name some other operators that have too, right? I know they've had challenges, but it's like, what do you do now, right? Is your team still supporting? Are you still getting communication? Are you still connected with your operator and your investors? I think that's the important part when you have challenges, because you can have challenges, and it's been quite frankly, our investors are on our team, right? We want to feel like we're on their team. And so, it's good to stay connected, but, support us, because we want to win. It's not that we're against you. We want this to be successful just like you do. So any kind of encouragement or questions, should come with an ounce of, hey, I'm in this with you. I understand that things go bad. Here's what we want to hear more about, or here's what, thank you for doing this, or, appreciate that communication, because it kind of goes both ways, right? We're still people that want to make sure your investment is ultimately successful. So
yeah, and
I hope that.
That's a great answer, because if you're on a 5-year plan and you're 2 years into it and it's having struggles, and I'm not just talking about one specific portfolio, I'm just talking generally, you don't know where it's going to end up in 5 years. And so the nature of the business that we've chosen to invest in is it's long-term and it's very illiquid. So part of that is good, right? It means that you can't make rash decisions, because you have, as a passive investor, we have no choice. We're just surfing alongside you. But you also have to understand that just because there was some challenges in the first 2 years, that doesn't mean that you're not going to knock it out of the park after 5. And it also means that if you had great first 2 years, that doesn't mean it's going to end up that way. So just things to think about, and I appreciate your candor on that. I did want to, you mentioned development when we just started out, so I just want to see if we can touch on that briefly as kind of, are you guys looking to do more development? And when you talk about development, is that where you're buying a piece of land with nothing on it and you're putting up a self-storage, or is it when you buy a self-storage facility and next to it there's some extra land and you build some stuff up there? It seems like there's two different types of development. So if you can talk about that generally, it'd be great.
Yeah, so our most popular fund this year, the one that I'm most bullish on, is our growth fund, which focuses just on ground-up developments or value-add. The facilities are the most upside. So that two things you covered: raw land development, or buying a facility that's got additional expansion, or maybe even buying a facility that was just recently built. So I think that's where the most opportunities lie, and here's why. I think that it's really difficult to build right now because construction costs are kind of all over the map, and it's difficult to entitle in some municipalities due to code changes and regulation. But most importantly, financing is extremely challenging. So a lot of projects are failing because, not our projects, but just company, industry wide, because they can't get financing. And but at the same time, if you want to buy a property that's already been built and leased up, you're still going to pay a premium for it with a high interest rate that is going to create a negative leverage situation. So, think about cap rates. Cap rates used to be higher than interest rates. Now interest rates are higher than cap rates. So now you have negative leverage. So when you go to buy a property, the bid-ask spread is so far apart to get to cash flow. So at the beginning of the year, we just said, you know what? We're not going to really probably find many facilities that cash flow because sellers are expecting a high price still. The market is paying for it, and the interest rates are really high. So let's just acknowledge that cash flow is not going to be much of a thing this year. We launched an income fund. We were able to put 2 properties in it this year. Now they cash flow really well, and the property, and if the interest rates go down even more, that thing is going to just roar with cash flow. One was bought at an 8% cap rate. But on the growth fund side of things, and a little bit of a tangent there, you don't want to be a speculator. You want to be an investor. An investor invests in all points of the cycle, right? They don't just wait in time because that time just is never right, right? So at this point in the cycle, my theory is it's hard to find cash flow. The bid ask isn't there. So how can you find value? Well, right now we can build for less than we can buy. And a metric that I like to go talk about, and I did a whole webinar on this, is called yield on cost. So yield on cost is kind of like your cap rate. A little bit different, but it's kind of like your cap rate. So yield on cost, if you take all of the construction costs, financing costs, land costs to build a brand new storage, and you divide that by, and you take the NOI at the stabilization in the pro forma, and you divide it by all those costs, you get a yield on cost. Right now, we can build for a 9 to 11% yield on cost. That's like buying a brand new facility in this market for a 9 or 11% cap rate. It's very similar, right? So then we build the facility for, say, a 10 or 11% yield on cost. And when that facility becomes stabilized, let's say it's valued at a 6 or maybe even a sub 6% cap rate, call it a 6.5% cap rate. You've created a spread between a 10 or 11% yield on cost and an exit cap rate of 6 or 7% even, right? So you've created value at a time where it was very difficult to find value because interest rates are so high against cap rates. That was a lot of numbers and a lot of math, but suffice it to, my point here is that it's easy you can find more value in ground up development if you can get it done. And fortunately, we've got our own construction team, our own development team. We're finding these really great parcels in high rent markets, like $25 rent markets, and we're building new self-storage. My theory is, yes, there won't be any cash flow, and maybe there might be a deal out there or a syndication out there that provides a tremendous amount of cash flow, and I think that's great. But in this industry, I think you're kidding yourself, I think, in self-storage, unless you're buying a facility in a very, very tertiary market, 100 units or something in in the middle of nowhere. Yeah, you can probably get cash flow on that, but it's going to be a lot of work. But I think it's very difficult to find cash flow right now with the way interest rates are. And I think building from the ground up is where we're finding the most value for the long term. So I hope that's helpful. We're building 3 sites right now in our growth fund. So
yeah, I think really that's a really great description, because what you did was you read the market and you pivot, right? If interest rates drop and cash flow is available, you can jump into that. But for now, development is the best place to put the money. So you're going in on that, and you do have the both options. So I think that was a great explanation. The last question I always ask is, what is a great podcast that you listen to? You cannot say Passive Income Pilots. That's already in the show notes. It's a great show. But if you can give us something else that you like to listen to, that'd be awesome.
I'm an avid listener of the All In podcast.
Excellent.
Love that show.
Yeah, I listen to that one as well.
I have lots of real estate podcasts and investing and all that, but All In it's just kind of like they're just breaking down. They interview politicians that you may not know anything about, and they'll do like an hour show with a candidate. Whether you're a Republican or a Democrat, whatever, doesn't really matter. I want to kind of know different things, not just investment stuff. So I love their perspective on things.
No, that's a great recommendation. And then lastly, if listeners want to get in touch with you or learn more about Spartan Investment Group, what's the best way to do that?
Yeah, our website, spartan-investors.com. or you can email me, Ryan at Spartan-investors.com.
Excellent. We will put that all in the show notes. And again, thank you, Ryan, for being on the show, and thank you to Spartan for being such a great partner for Left Field Investors. We appreciate that.
Thanks, Jim.
Aspen Funds has been a consistent supporter of Left Field Investors. You may have seen Bob Frazier on an LFI webinar or at our October meetup in the Left Field speaking on investable megatrends for the next decade. Whether you're an accredited investor interested in mortgage note funds with a 10-year track record or other macro-driven alternative investments such as industrial, oil and gas, multifamily, or retail, the Aspen Funds team is keeping track of the economic trends and co-invests on every deal right alongside you. Meanwhile, you get to do what you love and make every moment count. Download their free economic report today at aspenfunds.us/LFI. Vyzer provides investors with a secure platform that displays a comprehensive view of all of their holdings on a single, holistic dashboard. From real estate syndications to private equity, crypto to traditional investments, with AI-driven, unbiased, honest insights to maximize return. Vyzer is your one place to rule them all. Automating performance tracking, projecting future cash flow, analyzing all your financial documents, and much more in one powerful solution, making it easy to follow the money. Sign up for a free 30-day trial now at Vyzer.co. It was fun talking to Ryan about self-storage. We've had a few self-storage operators on recently, and so it's always fun to hear different perspectives. And I like the way that Ryan started out, with pilot crash pads. And it is amazing that when you just take a chance and do something like that when he's in his early 20s, right out of college, I am sure he didn't expect that would be the career that he would end up doing over and above being a pilot. He'd turn into real estate and then self-storage. So it's just an interesting story, and you never know where you're going to go, and things happen without intention. It's similar. Left Field Investors, we did not start this on purpose. Almost none of the stuff we've done with this business is purposeful or intentional, but it turned into a business. It was going to be a small little mastermind, and now it's this big business. Ryan started out with his little pilot crash pads, and now he has a gigantic self-storage business. So it's just really cool at little small decisions where you end up. In talking about self-storage as the asset class, I really like the way he calls it disruption is what is good for self-storage. We've talked about and we've heard people talk about that recession-resistant asset classes. And maybe that's true, I don't know, but disruption, this is a asset class that does well any kind of disruption because people are moving around. I think it's good to recognize what causes your asset class to excel. And it's not just a recession, it's the disruption that comes from the recession. So it also did well during the pandemic for the disruption there and then the disruption afterwards. So just very interesting the way he talked about it. And I always like when an operator is willing to spend time on talking about their challenges, mistakes. And he mentioned, the mistake they made on that one portfolio probably was trying to bundle up cash flow and appreciation into the same investment, because then you get two different types of investors in there. One's investing for cash flow, they're going to be disappointed, and the one investing for appreciation might be disappointed as well. So next time they would separate those, or as I know a multifamily operator, I know they do both in one fund, but they label it that you're going to have a little bit of both. So it's just managing expectations. But as I said, I really like it when an operator is willing to come on and say, hey, we've had some challenges with this property or this group, and here's how we're dealing with it. You notice that Ryan spent more time talking about the challenges from the difficult deal that he has rather than talking about all the successes he had from the deal that I'm an investor in that went really well. So he was spending more time talking about the challenges than the successes, and that just means that's because he's focused on turning that challenge into a success. So I really like that. And then talking about development at the end there, that it is cheaper now to build than to buy something existing, and to pivot from doing mostly the buying I'm stumbling on my words, buying properties that are already built up and you're just doing a value add or adding something on, but building ground up, and why that is so much in favor now, given the market conditions. So a lot of stuff there from Ryan. Really appreciate him being on the podcast. As I said, Spartan is a great partner of ours, and we appreciate that as well. So that's all we have for this time. We'll catch you next time in the left field. Thanks for hanging out in the left field with us today. If you are interested in becoming a left fielder, you can find us on the World Wide Web at www.leftfieldinvestor.com and click the subscribe button to join our community. If you enjoyed the podcast, please subscribe to the show on your podcast player so you don't miss an episode. If you really enjoyed the show, a review on Apple Podcasts or wherever you listen to podcasts would be appreciated.
This show is for entertainment purposes only. Nothing said on the show should be considered financial advice. Before making any decisions, consult a professional. This show is copyrighted by Passive Investing from Left Field and Left Field Investors. Written permissions must be granted before syndication or rebroadcasting.